Hey guys, Hadley here, New Zealand Property Buyers. So today what I wanted to share with you is 3 examples of what property looks like at the moment. One pre-27 March 2021, one post-March 2021, or what property is going to look like post 30th of March 2025, and then what a property in social housing looks like. Now, I'll explain all of those things in a little while. The key thing to remember is today's video is not accounting advice or specific to you. It's also not financial advice and specific to you individually. So these are 3 generic options of the same property at $500,000 and what it looks like under the 3 different circumstances, shall we say. So what I'll do is I'll change over my screens and I'll carry on with you guys just in a tick. Alright guys, before we get cracking, what I want to do is just quickly run through a couple of things, which is the 27th of March 2021 was when the government introduced the new rules around interest deductibility on existing residential rental properties. Now, if you want to find out all the definitions around this, what qualifies, what doesn't, jump onto the IRD website, which is ird.govt.nz. Really helpful website that's going to tell you exactly what those are. The long and the short of it is that if you have an existing rental property that is not in social housing, you haven't got a new code of compliance because you've created some new living spaces, or it's not a new build, it doesn't comply with the rules. Now, if you bought something prior to the 27th of March 2021, the IRD is phasing out the interest deductibility on the properties between then and the 30th of March 2025 at 25% per year. So important to keep that in mind. Because if you've got existing rental properties, you may not be that affected this year, but every year as you go forward, you're going to start to get a bigger tax burden unless you do something about it. So run through the numbers here really quickly. We've looked at a property that's got a gross yield of about 7.8%. So we've got a $500,000 mortgage on the property, rented at $750 a week here. And because we're renting it to normal renters, we need to allow for some vacancy. So we've allowed for 2 weeks of vacancy there, giving us $37,500. By the time we take $2.5 grand out for rates, insurance, we've put in $1,800, maintenance, pretty a little bit lean there at $1,000. You'll see the property management in there at 10%. That's to include the GST component of it as well, so not working inclusive and exclusive. Then you'll see here we have this interest deductibility, or this interest expense of $25,000, leaving our total expenses at $34,050. Now, that's what you would expect. And then what we do is we simply take away our income minus our expenses, gives us our net taxable profit. And so what we've done next is apply a 33% tax bracket just to keep things in line and simple. We have $1,139 in tax, which leaves us post-tax there of $2,311. So that's prior to the changes. Now we'll have a look at what a house is going to look like if you've decided to purchase one on the 28th of March thereafter, and you haven't taken any steps to ensure that you're going to minimize any of that exposure. So when we look at that, we come to page 2 here, which is the same thing. We've got our $37,500 there from our yearly income. We've got our rates at $2.5 grand. So all these numbers are exactly the same. The thing you'll see here is that the interest expense becomes 0. So we don't take this out of the expense. Under the new rules, it's seen as a profit. So what we have there is we now have our total expenses, of $9,000 from when they were previously $34,000 worth of expenses, and then that then falls into our net taxable profit. So then what happens is that we work out that 33% of our profit gives us a $9,388 tax bill. And then we're sitting there going, well, hang on, we didn't make all that profit. You know, we were supposed to have a $2,000 a year positive property. Unfortunately, when you take the interest out, which is your biggest expense, we then have to find $5,938 out of our pocket on top of what we've already spent. So what you thought was a cash flow positive property after tax at $2,000 a year has become a liability of nearly $6,000 a year from a change in rules. Now, we've got some options. We can either go, right, we'll sell the property because this isn't what I intended it for. Or the second thing that we can do is to go, right, I'm just going to be stubborn and I'm just going to pay the tax bill because that's what I think we should do and it's the right thing to do. Or the other option is to go, right, what are my options to make this property something that's going to fit within the new government rules? Now, there's sort of three things that we can do. Number one is that we can get a new code of compliance for an existing dwelling where we turn one dwelling into two. Now, once again, talk to your accountant about whether that's one code of compliance or two to make sure you're getting the right tax advice. You can relocate a property on a existing property and then add another one so that we're adding space. Once again, talk to your accountant as to how that looks from a COC perspective. And then the third thing we can do is do what the government's also asked us to do, which is increase our social housing pool. Now, this by far is the cheapest and the easiest way to come into the loop of the interest deductibility or the interest exemptions again. So what I'll do is we'll flick over to the next page here, and the difference between this one and the top two screens is that when we're in social housing, we have contracts of a minimum of 52 weeks of the year, up to sort of 3 years. So we guaranteed the rent each and every week for those weeks. So instead of being at 37,550 weeks of the year, we've now got a property that's at $750 a week for 52 weeks of the year. Our rates remain the same. Our insurance remains the same. Believe it or not, they are very close when you're looking at social housing insurance and also standard insurance. You've just got to make sure that you've got the right cover for it and that your insurer knows. It's all very well not telling the insurer about it to try and keep things so-called safe. But if something goes wrong, you're going to find yourself in a spot of bother. So make sure your insurance is right. Maintenance is there. Property management, I've put down at 6.9%. This is what we charge in a service that we offer, and that's our rate. And then you'll see here, our interest has come back in to the expense list. So from the previous property where we had zero for the interest, we're now back at $25,000 for the property as an expense. So when we take off the total income minus our total expenses, we have our net profit there of $6,009. 33% of that's $1,983. So we've got a post-tax profit in this instance of $4,026. So we're far better off than what we were if we were buying the same house and not putting it into social housing. And we're better off than what we were under the old regime with having a house that we may have had vacant for a week or two at the same time. So bearing in mind, guys, this example and the previous example is for properties that we're purchasing now, or the numbers are going to be closer together if you've got an existing property that you're bringing into social housing. So for the final bit of this, let's have a look at what the difference is in profit margins. So if we look at exactly the same house that's rented out to renters, we're going to have a negatively geared cash flow property of $5,938 a year. That same property pre-March 2021 was 2,311, and if we put it into social housing today, we would have the profit of $4,026. So that's a difference between exactly the same house, just depends on where you put it, of $9,964 per year in your pocket rather than going out. Now, you might also be thinking with this that it might not be the right thing for you. The best thing to do is just have a chat and see whether it is the right thing, whether it's a fit for your strategy, and looking at all the options rather than just ignoring one because you don't fully understand it. Now, the thing with this, guys, is that if you've got multiple properties or you're looking to purchase multiple properties, this is going to be a factor of obviously the number of properties that you've got. So if we're looking at two, we're looking at nearly $20,000 a year that would be better off in your pocket if we can get the property into social housing rather than just leaving it rented to people that are looking for rental properties. The other thing that you might be thinking is, 7.8%, that's ridiculous. These are the types of properties that we're buying at the moment, and these are the type of properties that you have to buy moving forward to make sure that you're staying ahead of interest rates and keeping yourself safe in case interest rates carry on going up. There's talk of them coming down, there's talk of them going up, who knows? But whatever you do with this, it's a long-term game, and you need to make sure that you're hedging yourself to make sure that you're safe going into the future. Now, if you've got any queries or questions on this, be more than happy to help you out, answer them. There will be a link down below for you to do that. Also, too, don't forget to subscribe to our channel. It would be really great to get some feedback, and any queries, more than happy to help you out with them. Enjoy the rest of your day. Thanks, guys.